Welcome back to the BDSM show, where we're talking about all things budgeting, diversification, savings, and money. Although I do change the diversification and debt because we haven't completely settled on what the BDSM or what the D in the BDSM is. But anyway, show is part of a larger B project that we're working on internally. And this time around, I can actually tell you that we have launched our first version of B last night. The guys worked really hard to actually make sure that we got it. I don't know, maybe this morning, whatever. It's all the same. So if you're in the market for education tools to improve your financial knowledge, head on over to b.com.au. My name is Ivan. I'm still here, surprisingly. Welcome back to another episode. All advice today is general advice only. And if you need anything more in depth, please speak to a professional. Today, we're focusing on the D and the diversification. Thus, we decided to change the debt back to diversification. And what better example of diversifying your investments than talking about ETFs or exchange-traded funds for those playing at home. What better man to talk about this than Kanish, Chugh, Head of Distribution at ETF Securities. Great to have you on the show, mate. Welcome.
No, thanks for having me, Ivan.
We have wanted to do this for a very, very long time, and then Corona got in. Well, you're actually going to be, I think, our first or second guest, and then Corona happened. We were just discussing that. It was been fun. And by the way, just to make sure that you guys can actually hear us, please type in yes into the chat. And if you have any questions, please type them into there, and we'll be running some cool polls in a second. But anyway, so you've had a few interesting years. You sort of worked your way up. Started at sort of BlackRock, I believe, or thereabouts, and then kind of worked your way up, and now you run or you head up the distribution at ETF Securities. How busy are you, man? Like, ETF Securities are exploding. How do you live?
Yeah, well, it's been, I guess, a little bit easier this year being in lockdown. So, literally waking up and going straight to the desk, or putting the kids to sleep and going straight onto the computer. So that does help. But I think it's been a crazy year for investment landscape. It's been a crazy year and a very good year from an ETF standpoint. And to be fair, it's probably been a very good sort of half decade from an ETF standpoint as well. And that's sort of when I came into ETF Securities, sort of joined, coming up to 6 years in February, actually.
Yeah, right. Wow. I'm about 6 years, so that's like my entire life. That's pretty good. So how it's funny, when sort of I was growing up, I trading really appealed to me, being that the kind of active trader. Always, I think I first started getting into trading about 14. In like a big jumbo book, and that always appealed to me. How do you get started on the complete opposite of that, which is kind of like, ETFs by nature are typically a lot more passive as an investment, but stats are showing they're pretty good. We'll talk about in a second. But how do you get started? How did you get into ETFs?
Yeah, so look, I guess tracking back a little bit, when I finished university into the mid 2000s, the GFC was sort of there. It was very hard to find a job, and I ended up in financial media. And so sort of tracked my way through financial media, and eventually was able to get myself a role at BlackRock on the distribution team there. And BlackRock at the time, this is going back nearly 10, 11 years, they had the iShares range over there, and a managed fund range. And the ETF landscape was very small. It was just growing. And I think this was the thing 10 years ago, a lot of, especially financial advisors, and that's where a bulk of ETF usage has traditionally been in Australia, were, what is an ETF? Why would I use it? I've got my unlisted funds. I've got an index fund, whether it's from Vanguard or BlackRock. Why would I look at an ETF? It started to move. There was a lot of work done, even at that time, by the iShares team in terms of what is an ETF. Just having to explain the acronym. And when I joined, sort of went through from BlackRock to Fidelity, so we're completely active. Which is great from my perspective, because I'm happy to sort of sit on this sideline. I joined what was ANZ ETFS. So for a lot of people, they're not aware. ETF Securities has been around for 16 years in Australia. It's the second oldest provider in the market here. And, we had the world's first physical gold product, so GLD. That's what most people know us for. But they did a joint venture with ANZ about 5 years ago. ANZ looked at the ETF market and thought, this is going to be gangbusters. We should join. And a lot of the big four banks, when they look to do something, it's very fragmented sometimes. There's not sort of the cohesive, holistic sort of strategy behind it. And unfortunately, from an ANZ standpoint, they looked to exit very soon after. They had a sort of a change in leadership, etc., which was good from ETF Securities standpoint. They rebranded, relaunched in Australia. Previously we didn't have distribution here properly, no portfolio management. So we relaunched new products away from just commodities. And I think for a lot of people about 5 years ago, that's when it's starting to shift in terms of usage of ETFs. So I look at it from three standpoints: financial advisors and the intermediary landscape, as I call it, your pure retail mum and dad investors that have really adopted ETFs more recently, and then the institutional landscape. And in Australia, ETF usage has been driven primarily, as I mentioned, by intermediaries. But they were starting to understand what it was, but they weren't understanding how to use it, or they were starting to move into that space. And to be fair to a lot of investors, there wasn't the range. You know, when we launched or relaunched ANZ ETFS 5 years ago, when I joined the business, I think there was about 80 ETFs available. We're now at about 200, 220, I think, is a current standpoint. So, and there's been some closures in that as well. So, you know, I talk to friends, I talk to clients, and they say, well, what is an ETF? Well, it's not an EFT, so exchange traded fund. It's very simple. It's simply a fund that's traded on exchange. So you flip that acronym backwards, and that's all it is. And it's not just, when they talk about passive, they talk about, well, it's just the market. It's just your ASX 200, the S&P 500. That's all I'm going to look at, you know, low cost beta. And it's moved on from there. It's evolved to the point where ETFs give investors the ability to take sector exposures, country exposures, you know, equal weight on the US market or the Aussie market, or, you know, even looking at smart beta. So, you know, we've got a low volatility, high yield strategy on US equities. Yield 5.6%, you know.
Yeah.
So that's where ETFs have evolved beyond just pure passive, traditional passive, is what I would like to say.
Yeah, and that's a really good point. Obviously, there's a lot of really interesting thematic kind of investments as well now. I mean, we were chatting a little bit about just before about some of the new products you guys have launched, and new products that you don't want to tell me about, but that's okay. We'll, you know, I'll have to maybe one day when we get to cross the border, I'll get you drunk and then trickle it out of you. We're running a poll at the moment. Have you invested with ETFs before? 40% have said yes, 60% have said no. Which is interesting. So for the 60% that have said no on that poll, what do you say? Why should they consider looking at ETFs and, you know, under a full general advice?
Yeah, exactly. Well, I think there's a few things. One is the diversification aspect, and you talked about it earlier. You know, that is something that we really want to hone in on. So a traditional investor that would trade stocks and trade shares, whether it's domestic and they may be looking at international shares as well, there's two things to consider. They go in and they know the stock that they're buying into, they've done their research, or maybe they haven't, but they're sort of choosing a few names, and they may have, let's call it a portfolio of 100,000, hypothetically, and they're going to have limitations around how many stocks they can choose. Now, they've got stock risk there, in terms of those stocks may move up, may move down, but that's going to have a big impact on their success or failure of their portfolio. With an ETF, it offers diversification, so it lowers the risk for investors. So if I look now, we've got a FANG ETF, which we launched in March. And, you know, it's funny, if we had launched at the beginning of the year, it would be the best performing ETF in the market. But unfortunately, because we launched in March, we can't use year-to-date performance, but it's up nearly 50% since we launched. And that is the FANG stock, so Facebook, Apple, Netflix, Google. It's got, and some additional such as Twitter, Alibaba, etc. So 10 stocks, equal weight. For an investor that were to say, well, I want to take Facebook. Okay, well, you can, or Amazon. Do you know enough about it to basically put 10% of your portfolio into that stock? And they may want to take that risk. There's costs associated with that as well, trading internationally. The alternative now that they have is they can use an ETF such as that. It gives them 10 stocks, all very similar in scope with all the FANG names, and it's very easy to do, and it's low cost. So diversification is key. It's low cost as well. So that ETF I talk about is 0.35% per annum. So if you held it for a 1 year period, your only charge from a management perspective would be 0.35% as a fee. So you've got diversification, you've got low cost, and then it's access. So again, a lot of Australian investors would traditionally say, well, I've just got my blue chip names. I may now have Afterpay in my portfolio, for example. You know, I've got the traditional Aussie names, Aussie stocks. What about looking outside of Australia? What about looking outside of, you know, looking at mega trends such as robotics? What about looking at other asset classes such as gold? How would you access gold? And for a lot of investors, They may not want to physically go to a vault or the mint, buy gold, store it, pay insurance on it.
Well, that sounds like a pretty fun thing to do.
It does. But then if I was to say to you, you can physically own gold very easily, make it very liquid to do so via an ETF such as GOLD, which is the ETF that we have. And we have over $2 billion in that fund now. So we actually worked, I think we've got about 22 or 23 tons of actual gold that sits in a vault physically back. So basically one semi-trailer worth of actual gold is that fund's worth. So it's an easy way to get access to certain exposures, asset classes, emerging markets.
Next time we have you on there, we're going to give you like a gold member cover photo.
Brilliant, I love it. Yeah,
that is ridiculous. That is a lot of tons of gold that you're effectively getting. So in terms of just going back to the FANG, the effectively the management fee that makes up that FANG ETF. So that's from memory, that's an Aussie dollar denominated.
Yes.
I think so. There's a currency hedge, and also there's some rebalancing going on if someone's going in.
No. So the FANG ETF it tracks an index. So again, all of the ETFs that ETF Securities have, we track an underlying benchmark. So the FANG ETF is tracking a benchmark that is rebalanced every quarter and resets the weights for those 10 names, and essentially that's it. So all that underlying transactional cost that is involved in managing the portfolio, we take care of, and obviously that's where the management fee comes into it. It is unhedged as well from a currency side.
Okay, that makes sense. And just in terms of balancing or rebalancing, can you just explain how that works? Just for
sure. So an ETF essentially tracks a benchmark. So a majority of ETFs that are pure passive in their nature effectively are tracking the benchmark. The best thing about an ETF is transparency. So we talk about why aren't people using ETFs? What's been some of the hurdles? So one, it's they would normally look at stocks, and I think there's really good value to look at an ETF as a complement or potentially as a replacement for direct stock exposure. There's also a really good place for replacing active managers that are underperforming and are charging very high fees. And there's quite a few of them. You do the research that S&P do of active versus passive. There's a lot of that.
So 80% of something underperform?
Essentially, yeah, depending upon which region you look at and large cap, small cap, there's quite a lot in the large cap space that are underperforming. But if an ETF is tracking an index, so let's look at equities, it's tracking an underlying equity index. So let's be simplistic in nature, and that FANG ETF, it's got an underlying index by the New York Stock Exchange, and that's what it tracks. The only time we essentially make any change as the ETF provider would be when that index makes a change. So as in passive house, which is why you can offer some of these funds at such low fees, is because we're not actively making decisions on we should sell Facebook now, we should be overweight Amazon or Tesla or anything like that. We're essentially saying that is the index, and there's transparency in that as well. So it's no black box with a lot of these things. So, whether the index is as simple as, just the market, it's a bit more complex, such as, we've got an ETF on robotics and automation, an ETF on technology, or an ETF on India, for example. It's simple. People understand the rules behind that index. They can do the due diligence. There's information there. So they know exactly what's happening. And to that level, we even publish the holdings of the ETFs daily. So for an investor, they know how much of their exposure is in FANG in Facebook. And on the commodity side, we publish the bar list as well. So they can even see the bars and the serial numbers and the weights for the gold bars and the silver or platinum or palladium.
It sounds like I'm going to have a lot of fun tonight. Really counting the gold bars. Jonathan asks, there are a lot of ETF providers for FANG in the market, like Vanguard, Invesco, and ProShare. How do we know which one is the best?
Look, in Australia, there's probably, I'd count maybe 6 to 7 main passive ETF providers. There's a number of active providers as well that have entered the market. So there's more than just the 7, but there's probably 7 key ones they're all slightly different. I think right now, as our market's growing, we haven't seen too much sort of stepping on toes. I'm sure that will be the case, and I'm sure there will be some, there are some products that are of similar nature. But right now, as it stands, I'd probably say there is no one leader in terms of products. We all have our nuances around them. From where we sit as ETF Securities, we use the tagline, the intelligent alternative. Sort of it sits in the back of on my shoulder. And that's really what we want to do. So we understand our benefit and sort of our strength is coming with products that are unique in the market and that are offering investors something more intelligent than what's existing out there, and then or may not even be existing. So that we launched the world's first gold product, for example. That is the one that is listed here. We launched the first product that covered India. So things like that. What I would say for Australian investors, there's 220 products roughly that they can invest in. Make sure you do your research. So something that we sometimes at ETF Securities want to do is educate investors. At the end of the day, we as a provider may not have all the funds, have all the exposures, but investors should know what is available to them. So we do a landscape document. It's called the ETF landscape. It's updated every 6 months. We just updated it last week. And that profiles every ETF in the market, which seemed a bit odd as a provider to do, essentially giving everyone's products a plug. But it gives us an ability to say, well, say you wanted European equities and you wanted to know what European equity products, pure Europe equity ETFs are there. There's about 4, I think there's 5. Now, there's a hedged exposure, there's unhedged exposures, some are broad Europe, including UK, some are just the Eurozone, some are 60 plus basis points. We've got an ETF on Europe. It covers the Euro Stocks 50. It's 35 basis points. Just Europe, just 50 stocks, just Eurozone, and it's unhedged. So just making sure people are aware of what they have available to them before making that decision. That's what I would say.
And then there's obviously you publish things like tracking errors and fees and all that kind of stuff. And that ultimately, and liquidity are probably the 3 main things that I can think of when picking between different ETF.
Yeah, exactly. And give the providers a call because I guess on the liquidity standpoint, liquidity of an ETF is
I'm giving your number out to everyone, just blasting.
Yeah, I'll put it on you. But it's basically the liquidity of an ETF is based on the underlying. And I think that sometimes people get confused with that. They sometimes see an ETF's just launched, it's only got $5 million in it, but the underlying could be very liquid. So be aware of that. And what you see on screen is not necessarily the liquidity of the fund. There's an underlying liquidity, as we call it. It's like the iceberg effect. So the tip of the iceberg is what you may see. There is a larger chunk of liquidity that sits underneath, and that's essentially what you can tap into. So don't be afraid from a liquidity standpoint.
As we're doing that, another poll. So actually, the yeses have overtaken. Maybe you peer pressure people into saying that. Also, 57% said yes. Is diversification something you actively think about for your portfolio? Yes or no? That is what we have right now in the polls. So vote. What are the big trends that you're noticing at the moment in terms of sort of sectors, thematics that people are interested in or where people are pushing money towards?
Yeah, so this year's been interesting. 2020, it's a bit of a roller coaster year. What we have seen has been really big influx of just general trading across the ETF market. So I look at some of the volumes on some of those products, and there's been certain outliers, and that's been in the leveraged and the short products as well. Now that's understandable given the volatility that we've had. So some of those products.
Sorry, do you want to just tell people just about what short actually means for the non-active traders in the room?
Yeah, so an example there. So we launched a ultra short NASDAQ 100 hedge fund in July, and we launched the ultra long NASDAQ 100 hedge fund. So basically betting on 2 sides. What it gives is the investors an ability to essentially bet against what the market will do. So that particular product, the short product, its code is SNAS or SNAS, as we call it internally. And if the NASDAQ were to go up, well, your investment would do the opposite because you're essentially shorting the market as sort of the name suggests. Now, there's leverage attached to that. So that leverage will be anywhere between 2 to 2.75 times. So in theory, if the leverage on that fund was 2 times on that particular day and the NASDAQ went up by 10%, well, in theory, your investment would go down by 20%. Now, I say in theory because that leverage changes on a daily basis. So what we tell investors is be aware of what that leverage is, and you can find that on the website to know exactly what it is. And the long is a leverage long exposure. So essentially you're taking an additional leverage on buying if the market were to go up. So if there was theoretically 2 times leverage on the long ETF, which is LNAS or LNAS, you're essentially saying that if the market went up by 10%, your exposure for that particular day would go up by 20%. Now, those particular ETFs have been very popular this year. To give you an idea, across the leverage and the short space, there's only a handful of funds offering domestic exposure, S&P 500, or for us, the new NASDAQ ETFs. They're basically tripled in size in terms of assets now, and the volumes of trading has quadrupled essentially. If you at December to what happened in March, April, May, it's starting to come down a little bit, and that's again because of that volatility. We've sort of seen that big swings in the markets allowed investors to look at it and go, well, I can take a view. You want to trade your conviction. So that's what we definitely saw. So that's been one big area, I think. And for investors that want to trade their conviction, be aware they are more riskier products. They are trading tools. They can be used to hedge against existing exposures, but essentially they're trading tools, and that's what people need to understand. The other big trend we've seen is on the tech area or growth trends. So disruption, battery technology has been a big one, and then healthcare and biotech. The FANG ETF I mentioned, nearly 130 million of inflows this year in that. And then
wow,
yeah, so that's been really interesting to see. Just again, people were asking for something more concentrated. They wanted an exposure like that. And then lastly, we've probably seen defensive assets, but not your traditional defensive assets.
Tobacco, come on.
Yeah, exactly. But not the fixed income. Very hard to look at fixed income right now with where rates are and yield. So a lot of investors have looked at gold. And so our gold ETF, I talked about it being the oldest in the world, it being, I think it was the 5th or 6th listed on the ASX. It took us about 15 years to get to $1 billion in assets. It took about 15 months to get to $2 billion in assets.
Wow.
And yes, it's some price move, about 20% move in price, but a lot of investors have said, well, if I want a defensive asset, I'm not going to look at fixed income because it's really not doing much for me. Cash, it's literally doing nothing. I may as well put it or some element of my portfolio into something like physical gold. So we've seen a big shift in investors around gold and silver, and so the metals, understanding how to use them in a portfolio, I think is a really big thing. So they're probably the three key areas.
Yeah, it's interesting. I'm hearing a lot more retail clients now talking about gold, because in the professional market they've been talking about that for a long period of time, and I think it's interesting as people are starting to realize that with all this printing of money that is occurring globally, I mean, it's almost a natural push in the positive direction for gold. In terms of I just want to summarize just in terms of the short NASDAQ ETFs. Effectively, if your view is that technology is overheated, you could go into the SNAS, SNAS, and get a 2-to-1 exposure to that, and effectively profit from a falling market. Best thing is it's obviously listed on the it's a ASX or Chugh listed.
Yeah, ASX listed. Yep. So
ASX listed. Yep. Yeah. So anyway, so you can get that through your trading, through any trading platform. And of course, on this line, everyone's sure using Open Trader, but anyway, exactly. If you're not, you can also look at the others. The poll at the moment is diversification something you're actively thinking about for your portfolio. 80% said yes, so it's interesting to see 80% say yes to that, and only 57% of the people on the line who are actually looking at using ETFs. How about? So we've spoken a little bit about active ETFs. What about some of the things that you can look at? Some of the thematic ETFs, for example, that you have, or some of the maybe something that potentially will give you a unique way of getting access to the market. What are some of the products you've got for that?
Yeah, so I think we call it the future present range, because there are about 5 ETFs that sit in that range. They essentially cover what the name suggests, the present current drivers of disruption and technology and growth, and then the future. So if I was to look at the present, we've got a tech sector ETF, and it's we track a Morningstar index, which is interesting because it uses Morningstar's MOAT methodology. And for people that aren't aware, the MOAT methodology essentially is looking at stocks, and it's got the sort of the fundamental Morningstar analysts looking at stocks that have a competitive advantage to their peers, and they have sort of drivers of that competitive advantage. And there's actually a valuation screen as well. So for a lot of investors that are looking at it and saying, well, I'm a bit scared, technology is a sector, well, that value screen really allows you to have a portfolio that is, essentially has some value built into it. What I would say is tech and like the FANG ETF, the crossover is bar one name. I believe it's sort of NVIDIA.
Microsoft, I thought.
Well, Microsoft's not in FANG at the moment. In our FANG ETF, but like a Facebook is not tech anymore. It got reclassified about 2 years ago. It's media and communication.
Netflix as well. Yeah.
Netflix, Amazon, consumer. It's not technology. A lot of people just go, oh, FANG, that's tech. It's Apple. Yeah. Apple's a tech name, but it's not actually in our tech ETF at the moment. But that's sort of an idea of where we see the present. And then your drivers of disruption. What I say about thematic investing is, if you personally believe that there's going to be some disruptive change in the world, and there's an inherent sort of link, that connection that you have, for example, for me, I like the idea of robotics and automation in particular, and I can see that already. We already have it in our day-to-day lives, but I can see it moving forward quite a lot. Therefore, I might look at that as a thematic, and we've got a robo ETF. And again, I talk about the intelligent alternative. That's just not an off-the-shelf index where we've gone, this particular index covers stocks that classify themselves as robotics and automation or artificial intelligence. There's some deep research done by the index manager, which is Robo Global. So when we do our ETF launches or development, we're making sure we choose appropriate indexes and not just going, let's just take the cookie cutter approach. And that's, again, how we probably like to differ. And just with Biden potential, look, I say Biden, he has essentially won the presidency.
He hasn't won yet. Come on.
He hasn't won officially, but if you believe the media outlets, he's essentially going to be the 46th US president. He's talking, one of his on the transition website that he's got, talks about clean energy, talks about, sustainability. And so we're seeing a lot of interest in our battery technology ETF, and the code for that is ACDC. Probably I'd say that's one of the best codes on the ASX for an ETF. But
that robot was pretty good. I didn't realize you got an ACDC. That's awesome.
Exactly. Yeah. But that essentially looks at battery technology and lithium mining. So it's not just Tesla, by the way. We think battery tech is Tesla. It's more than Tesla. There's a lot of different companies, about 30 names. Again, equal weight as well, because all those future present products are equally weighted. You have to take a view. I'm not going to buy a particular stock. The largest stock may not be the best driver of performance. You want to take the trend or the thematic or the sector. And I think we're actually going to be talking about it in another webinar for yourselves in a few weeks as well, just really diving into that space.
I think one thing that's interesting is, I've sort of been following the semiconductor space and that sort of, that's a really interesting space. And they're trading at pretty serious multiples. So again, going to your point about, do your research before you go into stuff, but there's some really interesting stuff going on in that, and I'm scared for what our phones are going to be doing in a go. They already know everything about us. I guess just before sort of run out of time, and if you do have any questions, please shoot them through. Just a few more questions from me, because I have to go to a compliance meeting shortly, which means that I really want to stay on this call for as long as possible. Yeah. So how does, when you guys are looking at creating a new ETF, how does that work? How do you dream up something to the point of actually listing it on the ASX charts?
Yeah, so there's a few drivers to it. It's obviously client feedback, client demand. We're speaking with clients on a daily basis and getting their thoughts, and they will come to us with, look, we're seeing this. Looking overseas as well and seeing, some of the trends that are existing in the US, in Canada, in UK and Europe as well. And then I'd say also just sitting and looking at the market itself and going, well, there is gaps there. So we've only got 200 plus ETFs. There's still a long way to go before we reach a point of saturation in Australia. We will see closures as well. So providers will close funds, they'll open new funds, but there's still more to be done. There's still gaps there. And we speak with the index managers. So but on the equity side, and the fixed income side, for example, there are underlying index managers, and we will speak to them. They have a whole raft of indexes that may not be available as an ETF anywhere in the world. They may be available in the overseas, and that's probably a good sort of point of inspiration as well.
Yeah, I think I definitely look forward to seeing. One thing that I saw a little while ago, I don't know if this is true, but you're definitely about to confirm it, is that compared to, I think it was actually Graham who mentioned this in the papers, was your Graham, was that like in US, ETFs are now a much more predominant part of the overall flow that occurs in the exchange. We're only a very small portion of holdings in Australia. Do you remember off the top of your head how much that is, and where you guys think that will be over the next?
I don't know it off the top of my head, because I would suspect it's probably increased over the past 9 months as well. I think it was sort of single digits 2019, and I think it's probably going to be it may have moved into double digits. I would say it's going to increase. If I speak to a lot of the younger generation of investors that are coming through, whether it's through Open Trader or the other platforms that have really allowed
there are no other platforms.
There are no other platforms. But they're starting to look and go. The older investor from 40 years ago may have thought, I'm just going to buy stocks. That's what I'm going to do. And then they thought, well, let me look at managed funds, because there's a big shift into that space. What you're now seeing is that investor that is now entering the market, the new investors are saying, well, actually, I'm going to look at an ETF. I don't need to look at a stock. Or if I'm going to look at a stock, it's going to be as a complement to the ETF, which is my core. So I'm going to buy a FANG ETF, or I'm going to buy, the US market or the Aussie market or whatever it is. And then I'm going to buy some DEX stocks, because that's how I can add the alpha that I want. So that's probably what I'm going to say is you will see it increase. I don't know, I can't say a number, but we will definitely see it increase. And, the market at the moment is about 73 billion. The latest ASX data just got released. So looking at it now, it's sort of sitting at 73.5 billion in terms of the ETF market. That's in October 2020. Where are we going to be sort of 2021? It's growing at about 30%. Year on year, 30 to 40%. So we could crack 100 billion next year.
That's a lot of $1 notes, $1 coins. I think I'm looking forward to it. I can definitely see from our audience, whether that be clients of Open Markets, obviously either coming through Open Trader or Self Wealth or Superhero or one of the other guys. And obviously we've got pretty much every robo using us for our infrastructure as well, and obviously because they're all ETF driven. There is a massive shift. Every week we release new data about the most traded positions. Ultimately, there's there's always in the top 3 on the bought and the sold side. There's almost always going to be an ETF or two, whether it be cash, whether it be bear funds, or whether that be so bear short funds, or whether it be some of the other just trackers. It's remarkable, and I mean, I guess. If Warren Buffett says it's the way to go, you almost kind of can't say no, right?
Exactly right. There is some theory into this madness. There's some real strategy, and I think for a lot of people that say I would never look at an ETF, or why would I? I'd say you may be misunderstood in terms of what you think an ETF is, because it may have been that definition that you thought it was 30 years ago, or 20 years ago, or even 10 years ago, or even 5. ETFs are here to help investors. We're not here to bully it. I think people sometimes look at the ETF and they think acronym, they think it's new, they think it's disruptive, they think it's negative. It's not.
Well, it is disruptive in some sense. If you're a managed fund, you're definitely watching everything disappear pretty quickly, because you guys charge less fees and you outperform them on almost every product. So, I guess, what do you do? But thank you so much for joining us. It's been awesome. I hope that we have you back soon. I don't know who you're talking to in a couple of weeks, but I look forward to watching that one. I thank you for being the first person on the show to wear a tie.
Oh, man, appreciate that. I'll remember that next time as well.
You'll have to dress down from your TV appearances.
Exactly.
No, just kidding. Mate, thank you so much. Look forward to catching you very soon.
Cheers. Thanks, Ivan.
Thanks, mate. Bye.